If you're thinking that the only path to retirement is working harder, saving more, and investing in the stock market till you hit 65, I invite you to the 10x Your Financial Freedom through real estate. I'm going to be going over my proven framework that I used to get to financial freedom at 41 in a few short years while working full time and raising young kids. And I know that you can do it even in the current market with interest rates the way they are, and even through a recession, because hundreds of our students, many of whom are busy physicians just like you, have used the same time tested strategies to acquire over $200 million of real estate. And on day 2 of the event, you get to meet some of them and hear their stories, how they got to 6 figures in passive income while saving hundreds of thousands of dollars in taxes in this market. So if you're tired, burnt out, and ready to take back control of your time and income, if you're struggling with getting your first long-term, short-term rental, or investing in syndications and you don't want to learn from costly mistakes, or you feel like you don't have the time or money to get started, or if you're ready to go from a handful of rentals to 10xing your cash flow, we will be building your personalized recession-resilient real estate portfolio so you can accelerate financial freedom while paying less in taxes. So get ready to go from working harder to working smarter. Register for the event at generationalwealthmd.com/event in lowercase, and I'll see you soon. Hey guys, I'm super excited to be back for episode 2 of this podcast series. This is the 2026 Wealth Playbook, how you can build freedom and passive income in uncertain times. And if you're a physician who's looking to scale your passive income, get off the hamster wheel of trading your time for money, and all the chatter about uncertainty in the market is making you stay on the sidelines, then this podcast series is for you, because 2026 is not going to reward last year's strategies, but there are still outsized returns if you know where to look. And I'm going to be talking to you about how the smart investors, sophisticated investors, are rethinking their portfolios, the rules and criteria that we use, and I'm going to be sharing all of that with you. If you were with me for part 1 of this series, we talked about what worked in 2025, real physicians, real results, right? Real success stories. 2025, there was a lot of market turmoil, and our students still created more cash flow and tax savings than ever. We talked about a physician who went from 0 to 2 cash flowing short-term rentals with 6 figures in tax sheltering within just 3 months. A couple with a toddler who had they'd created over 40,000 a month in income from their rental portfolio in 2025, right? That's when they were scaling. We talked about a specialist who got 6 figures in tax sheltered income investing passively in syndications. That happened in 2025, right? And we talked about common pitfalls that they all avoided. This is going to be another year where the opportunities will exist, right? And you have to lead with clarity, and you cannot fall prey to the headlines. And so in part 2 of this series, we're going to be talking today about building passive income in a volatile market. Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param Baladandapani. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review. Again, this is a transition year. Old assumptions are not going to work in 2026. And the thing is that most people don't really see that because the signs are subtle. I've been investing in real estate from 2014. I've partnered in over 2,000 units, and we currently manage a portfolio of over $500 million with our partners. And we're reviewing hundreds of deals a year to invest in a handful. And many times over the last year, I've walked away from deals. Which look good on paper, which my team was ready to move on. The numbers made absolute sense. But it wasn't because something was wrong with the property, but because of what I was seeing in the market and how we have been analyzing deals and deploying capital has shifted, right? Because the assumptions that were baked into deals previously, that's not going to work a few years from now, right? And that's the kind of decision making that I want to share with you. I want to share with you what you need to know to win in 2026. I don't want you to be chasing forecasts, right? I want you to lean into fundamentals. And so we're going to talk today about what I'm seeing in 2026, right? What I'm seeing for 2026 and beyond. How are you going to plan for market volatility? What are we seeing in terms of the fundamentals? We'll talk about what strategies are working, and we'll also talk about a hidden lever that most people miss that is really going to help you boost your passive income. So let's get started. Okay. Again, like I said, this part of this podcast series is really trying to tell you how I'm looking at 2026 fundamentals for the market and for real estate, right? And how to deep dive and look at that data because everyone's going to interpret the data differently. How are we going to interpret that data to make sure that you succeed in 2026? So if that's what we're thinking about, then I want to go over 5 markers, right? If I'm looking at data points to use to use towards decision making, this is what I look at, right? And these are the 5 points that I want you to also take away from here and use that as your goalpost, your North Star as you make decisions for this year. Now, when we talk about decision making, it's twofold. It's what we're seeing in the market, overall economy in general, and what we're seeing in real estate. So we're going to deep dive into that, right? So the first thing I want you to take away from market fundamentals as we look at 2026 is that this is a year where you have to plan for market volatility, right? And you've heard me say, if you've listened to me speak before, you've heard me say this. You're always planning for worst case scenario. You're not planning for best case scenario, right? Because you're planning for worst case scenario. Your goal is going to be downside protection. If your goal is downside protection, capital preservation, then you're planning for worst case scenario. And if you're doing that, you have to plan for more market volatility. We don't know what's going to happen with labor costs, with tariffs, with inflation. And so the cardinal rule for 2026 is to have a plan that's flexible and that works with market volatility, right? And so we can't write off market volatility in 2026. You plan for it. Now, when we talk about it, the 2 big things we're going to talk about are going to be inflation and interest rates, right? So the economy is going to be volatile. What are the 2 big indicators we look at? One is going to be inflation. The next one's going to be interest rates. When we talk about inflation, a lot of this presidency policy is pro-inflationary, right? And how does inflation affect real estate? So if you're thinking about investing passively and generating income in this market, I always say this, if you heard me say this, why should physicians invest in real estate? It's because for or threefold, right? When you invest in alternative assets like real estate, that is when you get significantly higher passive income. That's what's going to get you to your passive income goals in 5 to 10 years instead of 20 to 30 years, right? And that's what I did. That's what everyone in our community is doing. And so investing in alternative assets really helps you increase because there's asymmetric risk reward. It helps you increase your return profile, especially passive income. And the second part of that is going to be diversification and reducing risk in your portfolio. The more non-correlated assets you have, the more you're going to be able to weather volatility, right? And so that's the second thing. And the third thing is tax efficiencies, right? The reason we're talking so much about real estate is because physicians have less than 5% of their asset allocated to real estate. We cannot include our primary residence because that's not income generating, right? And so I want you to have at least 25 to 50% of your portfolio in alternative assets like real estate. And another reason is because in a pro-inflationary environment, real assets that are inflation correlated, like real estate, and commodities, right? They will increase in value, right? So the problem with commodities is that they will increase in value and they're a great hedge against inflation and they are good for security and liquidity, but they don't generate income, right? And so if you're looking for something that has the advantage of being inflation correlated, but also generates passive income, then that's real estate. And when in a pro-inflationary environment, as in real estate investors, rents increase and asset values increase, right? And what we've seen happen, and so this happened in 2020 and 2021, right? For many of you know that that's what happened. There was a spike. You saw rents go up. You saw asset values go up. So if you owned a primary residence, that's what you saw, right? So significant bump, right? And we are again in a pro-inflationary environment. Now, when that happens, what we've also seen is that property taxes and insurance goes up, right? And so that's a concern. So some people will look at this, especially if you haven't owned real estate during that spike, and say, Okay, well, but property taxes and insurance went up. So was it that much of an advantage? And the answer is yes. I'll explain to you why. When rents increase, right, property tax and insurance can go up, and there's a lag period, and we'll talk about that. But your biggest fixed expense, which is your loan, which is amortized and hopefully fixed, does not go up in value, right? So your biggest expense stays fixed, but your income is increasing and your cash flow increases, right? So in pro-inflationary environments, you want to be invested in cash flowing real assets that are inflation correlated, right? So that's one advantage. Now, in 2020 and 2021, you'll see a lot of people, especially in Texas and Florida, talk about property taxes going up and insurance going up and how that's affecting them. Anyone who owned real estate, and this includes multifamily, single family rentals, 2020 and 2021, got the bump in asset value, in the price of the asset, and in rent in those years. And then they saw a bump in property taxes and insurance, but they were still cash flowing higher because their rents increased, right? And so they benefited from both of these things. So they weren't affected as much. The people who were affected is people who saw inflation hit in 2020, 21, saw how valuable it was to have leveraged real estate, and then went into real estate, acquired, but they didn't really benefit from that inflation hike that affected rents and values, but they saw property taxes and insurance going up. So all their assumptions thrown out the window, right? And those are the people, those are the owners who are struggling. And I want to distinguish owners who had owned prior to 2022 from the scenario of people who owned after 2022, right? And that distinction is important because when you listen to people talk about inflation and how it affects real estate, I want you to have a holistic picture, right? So it's really important to get in the game before that first inflation spike, so that that affects rents and asset values, so that when property taxes and insurance kind of later catches up, you're not caught in that lag period. So you don't want to get caught in that lag period again, right? So if you're someone who wasn't in the game in 2020 and 2021, right? So you did not own real estate at that point, then you want to get in the game ahead of the game, right? And so if you're looking at economic markers and you're looking at inflation and thinking about how it's going to affect 2026 ownership, that's what I want you to think about. I want you to think about getting in the game. I remember in 2020, prices were going up like crazy, and people were saying, well, don't go and buy now because we're at the peak. Wait for prices to drop because there will be a second wave. And I kept acquiring because the numbers made sense. The math made sense. We're again in a period where the math is finally making sense again, right? The math made sense, and those assets increased in value, right? And so I want you to think about inflation holistically. That's what's going to happen. We are in a pro-inflationary environment with tariffs, with government policy. So be very intentional about your asset allocation and make sure you have real assets that are, the inflation correlated and non-correlated to the stock market. That's what you want to do. When you have market volatility and you have potential inflation, you have to get in the game ahead of time, and you need to be in assets that are non-correlated to the stock market, right? Real estate is one of the best hedges against inflation because you're using leverage. When you're using leverage, if you have 100K in a property that's worth 400K, and then because of inflation, the property goes up in value to 500K, think about it. You have 100% ROI because you have leverage and you only have 100K in that property, right? So don't fall prey to market volatility. Be intentional about your acquisitions. Be intentional about asset allocation. Okay, now the third thing I want to talk about in terms of overall 2026 trends, how do you plan for it? And this is what sophisticated investors are doing, is interest rates, right? And yes, we are in an environment where interest rates are dropping, but what you have to remember is that we are planning for worst case scenario. And so we don't know with the new Fed chair, with policy, with inflation beginning to tick up, right? What you have to plan for 2026 is that interest rates can go up. We've been saying this in our community, even for 2025, even though rates were dropping. If you're planning for downside protection, then you're someone who needs to intentionally plan for interest rates going up, which means what? You have to be intentional about acquisitions, right? You have to be intentional about debt. And we're going to talk about that in episode 3, right? What are the 5 cardinal rules for investing in 2026? But that's one of the things. If you're thinking about, when I look at 2026 and when I look at the market and the economy and real estate, what am I thinking? You have to plan for interest rates going up if you are someone who's looking to preserve capital and you're looking for downside protection. Okay, the next one is going to be rent growth. What can we expect for rent growth in 2026, right? I'm just picking the 5 biggest markers that I want you to focus on when you think about the market, when you think about real estate. The next one's going to be rent growth, right? And we're talking about organic rent growth. Rent growth because market rents are going up, not because of the things that you can control. We'll talk a little bit in episode 3 about how you can control the things that you can control, how that can really move the needle. We talked about that a little bit in episode 1. We'll deep dive in episode 3. But if you're looking at organic rent growth, then I would say in 2026, if you are being a serious investor and you want to think like a serious investor, you have to plan for a plateau of rent growth, right? And a big part of that is going to be because of what's happening in the economy. If there's market volatility, if people are concerned about jobs because of immigration policy or because of AI, and just because of pure volatility, right? You have to plan for rent growth plateauing. A big part of that in the multifamily and the commercial space, commercial residential housing space is also going to be supply hitting a lot of markets. Supply is steeply dropping in 2026. That being said, if you look at the self-storage space and even multifamily in some markets, supply is going to be a big determinant in terms of why organic rent growth will likely not happen, right? And so the challenge for real estate investors is to find creative ways to add value. We talked about that a little bit in episode 1. We will deep dive in episode 3, right? The strategies where you can control, and this is the beauty of real estate, how you can control rent growth, but plan for organic rent growth being kind of plateauing or being very, very close to inflation, to that 2 to 3% mark, right? And a big part of that, like I said, is because of economic volatility and because of supply. Okay, so organic rent growth, that's what we expect. That's what you're planning for if you want to be conservative.
If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.
But that being said, if you're taking a look at the overall economy, I also always want us to be intentional about zooming back out and looking at long-term fundamentals, right? So if you look at long-term fundamentals, we are a nation that is in housing shortage, right? We're still in a shortage of 4 to 5 million units as far as housing. And we are in a housing affordability crisis because asset values are high. This is true for single family. Multifamily saw a drop in values. The single family is going to stay steady, right? And likely start going up as inflation starts ticking up. And so that combined with interest rates being where they are, we're still in a housing affordability crisis. It's much cheaper in some places, almost half the price to rent than it is to actually own real estate, right? And so that's something we want to be intentional about. Okay, so we're in a state of housing affordability crisis, right? We have a nationwide housing shortage. And so the long-term fundamentals for owning real estate is really, really strong, right? Especially in a pro-inflationary environment. And know that in the past, every time we've had a downturn, right? That's 07, 08. That is in 2020 during the pandemic. Every time you have a downturn, home prices can fluctuate in value, right? They can drop. They dropped almost 30% in some markets, right, during 07 and 08. But rents fluctuate by approximately 10%. They drop by about 10% and they go right back up. And that's because that fluctuation in rents is always right in that 5 to 10% range. In 08, 09, it dropped by 4% and then by 5% before going right back up, right? And so that's a very small fluctuation, and that's what you account for. We've already seen that fluctuation in rents across the country, and so we're trended back upwards. And so zoom back out, look at the long-term fundamentals, and that's what you need to lean into for 2026, right? And so hopefully that gives you an idea of how long-term sophisticated investors are looking at 2026, why they're being opportunistic about it, and what the overall fundamentals are, what you need to plan for, and what you need to plan for both from an economic standpoint and also from real estate underwriting standpoint, right? And so hopefully this gives you an idea of why sophisticated investors are very bullish on real estate in 2026. but they're also shifting their strategy based on what we talked about, right? Based on supply in a market, based on organic rent, not, being intentional about those organic rent growth assumptions, being intentional about the kind of debt they're taking, right? And so that's what you need to factor in. That's what you need to be looking at as we enter 2026. Now, we'll talk a lot about strategy. We'll be talking a lot about the 5 rules. I say, your criteria, having non-negotiable criteria becomes really, really important in an environment where we have economic volatility, which is what we're going into, which is what we're planning for in 2026, right? And so we're always planning for worst case scenario. And so we will be deep diving about it. But if I want to superficially take a look and say, okay, that being said, what does 2026 look like for doctors who want to increase their passive income, right? How can they invest in real estate and still stay hands off and, not create another job for themselves while creating the source of income that is not just a source of income, but it's also simultaneously increasing in value, increasing their net worth, increasing their wealth, right? Unlike another side hustle where you're just generating income by trading your time for money. How do we build something where you're not trading your time for money, you're generating passive income, and where you are, increasing your net worth, right? As this is happening without drawing from it, that's where these passive income strategies come in. And I want to zoom out, give you a high level of, okay, how are we thinking about it, and then we'll deep dive about the criteria in episode 3. But the rules, the name of the game in 2026 is going to be planning for worst case scenario and eliminating any variables, right? Because uncertainty doesn't mean there's danger. It just means that you need to invest strategically with a plan that works, that eliminates variables, that works in the worst case scenario. Okay, that's what we're thinking about now. When that comes to short-term rentals, some of you are thinking, hey, I want these massive tax savings. You listened to episode 1, you saw how physicians are still sheltering close to $1 million of their inactive income from taxes, and they did it through short-term rentals. And you're thinking, okay, what is my key takeaway here? The key takeaway is that you need to be acquiring cash flowing rentals and you need to focus on optimization. Okay, so it's not enough like in 2020 and 2021, you could just buy a short term rental, list it, and it would work, right? Now you need to be very intentional about stress testing those deals, finding properties that are cash flow positive, and then you need to be intentional on the back end about listing optimization, right? We have students within the program who are at 70 to 90% occupancy in their short term rentals even throughout 2025 with the volatility that was there in the market. They're doing it through direct booking. They're doing it through listing optimization. If you're someone who says, hey, I want to get those tax savings, but I want to do this intentionally, then hopefully you've already signed up for our 10X event coming up in March. generationalwealthmd.com/event. We'll have these physicians come and share their stories, share their challenges, and share what they've learned and how they're actually able to get these results, right? So it's about cash flowing acquisitions, stress testing them, and then listing optimization. It has to be optimized if you want to generate significant revenue. And then there are ways for you to stay passive in this, right? You can have virtual assistants. We have a team of virtual assistants who support our students, right? Where they can be passive, they can get the tax savings, but in year 2, they're completely passive. You can automate your systems, right? There's so much you can do to still not spend more than 2 hours a week and still generate. We have students generating over 200,000 in gross revenue from a single short-term rental. Just think about that, right? And so it's doable, and we'll deep dive about that. We'll talk more about strategy in the 10X event. That's for short-term rentals. And then those of you thinking, I want to stay passive in long-term rentals, the key takeaway I would say would be think of this as a long game, right? If you find properties that break even in the current interest rate environment or are, cash flowing at less than 5%, that's okay. Don't get aggressive about rent growth through value add, right? This is the era of creative value add. Think about catching up on market rents, right? Loss to lease. How do you catch up on that? That's low hanging fruit. Think about expense optimization. That's what we're thinking about. Again, if this sounds, if you want to like deep dive into these strategies, that's what the 10X event is for. That's what episode 3 of this podcast series is about. But we'll deep dive even further during the 10X event. So just sign up. If you're someone who's thinking, hey, I'm investing passively in syndications and commercial properties. How do I take this information about the market? What does that translate into? We'll have the 5 non-negotiables we'll talk about in episode 3, but the big takeaways are going to be anyone thinking about investing in syndications and commercial real estate, like lump them because the debt is very different, right? This is where you have commercial debt. And so anyone on the commercial side, you need to be very intentional about debt, right? Because having fixed rate interest rate debt is very important because we don't know which direction interest rates are going to go. And I want you to be planning for that. The second thing is going to be very intentional about buying cash flowing assets. And you will hear people say, oh, well, this is, or we'll think about upside. Cash flow is kind of hard. Let's go into strategies where we'll think about upside and you can, but if you're someone who's thinking about downside protection, then going into assets that are cash flow positive and even in this environment is important and is possible. We've been acquiring assets that have, anywhere from 6 to 10% in cash flow starting day one, and this is from pure cash flow. And if you haven't explored our latest opportunity, that's gwcapital.com/Houston5, Houston, and the number 5 in lowercase. And that's an example of how we're going into these cash flowing assets. And if you look at the webinar, I actually go over the numbers about how, like I said, the game is expense optimization. We're reducing 400,000 in expenses in year one, and using a proven playbook that is going to increase the asset value significantly, right, by millions of dollars. At a 5 cap, that's increasing the asset value by $8 million, right? So there are ways to go in. The game is cash flow, and the game is also being very intentional about debt. And so passive income strategies are available. Those would be probably the key takeaways for each of those strategies. And so know that that's possible in 2026. It's almost necessary in 2026 to be invested based on everything I told you about the market, to be invested in inflation correlated real assets that generate passive income. And that's real estate, right? Businesses are trickier with economic volatility, right? And that's why real assets with the underlying real estate that is inflation correlated, that's super, super important. And episode 3, like I said, I'm going to talk about how we stress test every property in my portfolio, right? The exact metrics that I use to determine whether we're holding or selling or we're entering it, not entering it, right? I'll talk about criteria. The goal is going to be to prioritize downside protection over optimistic projections. That's the goal for 2026, okay? And it doesn't eliminate risk completely, but it reduces the odds that market volatility is going to affect your portfolio. And that's key to 2026. Now, the last and final thing I want to mention is going to be the hidden lever, which is tax savings as a source of income, as a source of return of investment, right? And again, if 2026 is going to be all about control as opposed to speculation, then tax strategies are going to be key for you, right? We've talked about in 2025 how doctors, with all of the volatility, sheltered close to $1 million in taxes through the short-term rental strategy, right? We've talked about how some investors who are busy practicing physicians, two-income households, they invested in syndications passively and are still getting 6 figures in tax-free passive income, right? And you can do that even with syndications. All the income you get from your passive syndications, when structured correctly, can be completely tax-free, right? And so that's very different from investing in private credit or investing in a savings account or a money market account or day trading or option trading or getting interest income or dividend income, right? All of that is taxed at your marginal tax bracket. So having sources of income that allow you to shelter your W-2 income from taxes, but also allow you to have 6 figures in tax-free income, that's from passive syndications. All of that is going to be super powerful. You cannot ignore that in 2026. Even when you're thinking about exit options, and we'll talk about this in episode 3, you're talking about diversification. Know that there are so many tax strategies that kind of play into how you can, when you have a diversified portfolio, they become like pieces to a puzzle where you're fitting them together. When you do it the right way, you're unlocking so much more in terms of tax efficiency. So tune in to the 10x generational wealth md.com/event, the 10x event. We'll deep dive into tax strategies over there, and you'll have tons of time for Q&A. And it's just 2026 is a year, if you haven't done this before, tax strategy should be a part of your wealth strategy, right? And so with that being said, 2025 already taught us this, right? Uncertainty is rewarding those who go in with non-negotiable criterias and a repeatable system. And that's what episode 3 of the podcast series is about, right? I'm going to, like in the next episode, I'm going to talk about the 5 rules that you have to follow in 2026 if you want downside protection, right? If this is what sophisticated investors are doing, this is what's going to protect your portfolio no matter what the economy does. And if you can master this in 2026, then you will definitely be able to get, 6 figures, multiple 6 figures in income that comes in even as you travel the world. You will be able to hopefully unlock, and this is my hope for all of you, right? Hundreds of thousands of dollars saved in taxes that can go towards building generational wealth because you don't have to pay all these taxes, right? That's not a given, right? That's not a given. That's not what people in our community are doing. So come listen to those stories, and you'll be able to really have autonomy for and time for what matters most. And like I said, the last thing I want for all of you is to wait for crisis to strike before you start pivoting. That's what I did. I don't want you to make the same mistake. You can learn through crisis and pain, and you can learn through other people's mistakes. You can learn through other people's insights. And I want that for you. I want 2026 to be your breakthrough year. So I hope to see you at the 3-day 10X event. That's generationalwealthmd.com/event. I will see you in the next episode. And if you're looking for passive income opportunities, don't forget to go and check out gwcapital.com/Houston5. That's Houston in lowercase and the number 5. I hope this episode gave you an insight into how I'm looking at 2026, how sophisticated investors are planning for 2026, and how it shows you how everything that you thought people could do 5 years ago, 3 years ago, still exists in this market, and it's getting it's helping you get your thinking cap on. Okay, and I will see you at the next episode. Take care, everyone.